Karissa, I do want to start with some of the moves that we've seen in yields since that Fed meeting, moves that aren't quite as definitive as you think they would be, given how definitive the Fed seemed to be about the start of a rate easing cycle. What do you make of it?
Yeah. Oh, thanks so much for having me on. We think, again, after the Fed ended up doing this jumbo cut, which we think was very effective, it was exactly the right thing that needed to occur. We think the 2s-10s inversion is over. And we do think that, it's not just a bull steepening with short rates coming down. We do think that long rates are vulnerable as well to continue to drift up. As you talked about, you have Moody's saying unhelpful things about the fiscal path of the U.S. economy. Some glimmers of inflation data here and there. So we think that this trend will continue to persist at both ends.
It's kind of interesting, too, like when you go through the Bloomberg terminal and you look at some of the moves that we've seen, not only with the disinversion of the curve, but to that point, sort of what people are buying across the curve. There's been a lot of talk about people still crowded into the shortest of duration, some questions as to why people don't extend duration. Is there some sort of in between here that maybe might, placate everyone?
Yeah, for a long time this year, we had been saying long end, in anticipation of Fed cuts. We're starting to say, the sweet spot is really the belly of the curve. You get a nice coupon clipping. You can benefit from price appreciation as rates come down at the front end, but you're not subjecting yourself to that rate volatility longer term. So that's kind of the in-between that we're looking at this point.
Is it surprising to you, Karissa, that you have rates coming down from the Fed, yet the money in the money market funds is staying really sticky? And when do you think that's going to move, and where does it go within the bond and the credit market?
That's an excellent question. Money market funds, those are going to be crowded out. Eventually, those investors are going to realize that those rates will be kind of dried up, and that's not going to be an opportunity. We think that is also going to come into this belly of the curve trade. We do still see some relative value in credit, particularly bank credit. We think investment grade industrial spreads are extraordinarily tight, but there are opportunities in other safe areas of the Treasury and the corporate bond market to go. And I think that's where they may look at this point.
Yeah, we finally saw Marcus. Did you see this, Romaine? Marcus Goldman lowering their rates.
Yes, yeah, really that was painful. Quick.
I know, I don't like it. But to your point, it has to come down a little bit more, Karissa, until I'm actually going to move that money out of that Marcus fund. And I'm wondering what you said about credit. Because if I want to go to credit, do I just have to continue to go down the risk curve at that point?
Well, and that's a careful kind of balancing act because, yes, you want to pick your spots. We still like kind of single A bank holdcos, kind of the big SIFI banks, those types of trades. But this is the period of time, again, it's a really transitional period where you don't want to get too careless in terms of your credit exposure because it's really great to get a 6% coupon until that company stops paying. So we caution at this point. It's okay to add some credit, but you really want to be deliberate about where you're adding it. Increasing high yield maybe at this point is a little long in the tooth.
Is that because you have some degree of pause on economic conditions, Karissa?
Yes, that's exactly why. Now, back to our initial conversation on the Fed, they are very forward-looking, and I think that, the data tends to be a little bit belated, but, we're seeing consumer confidence come down. I know that, rates are coming down now, but often, you start to see the Fed cutting maybe 2 to 3 months ahead of recession. So I'm not suggesting that that's automatically where we're headed, but I do think that there are pockets of weakness in the economy that investors need to be aware of.
Well, I'm curious for yourself, when you look at the market moves that we've seen and the participation in the fixed income space specifically that I'm talking about here, do you think that the price action we're seeing is transparent? Is it really reflective of those conditions, or at least how people perceive those conditions?
I think so. There's always a little bit of a lag effect when you talk about risk taking, and I think sometimes people need to be a little bit shocked by. You were talking about events earlier. Maybe there needs to be an exogenous event for people to remember that there is credit risk present. But I think that bond investors try to be forward-looking as well, as equity investors, and so. If the Fed is busy cutting, it's not just, hey, we're going to benefit from lower rates and things are fine. No, I think they are seeing some very concerning trends occurring. And, like I said, there could be some degree of lag or recognition on the part of investors, but we're trying to be forward looking.
So when the back end sells off, is that what that forward-looking scenario is telling you, that it's the real risks in the economy versus equity investors are always going to be more optimistic and are looking at the cuts that will then help the risks in the economy?
Yeah, I think bond investors as a class tend to be a little bit more pessimistic. I'll tell you, I've never seen a total return month like we've seen in September, and I would not suggest that that's what we're going to see for the balance of the year. I think that we are going to see long rates drift a bit higher. So yes, that's exactly what's happening.
When you look at the Fed messaging then, do you think the market moves to the Fed finally, or the Fed moves back to the market?
No, the market understood that the Fed was serious. The Fed, you can have the most effective policy in the world, but if the market is shocked and awed, then it is not implemented well into the real economy. The Fed's gotten really good at effectively messaging and jawboning. They had all kinds of people in front of the press saying, now's the time for 50 basis points, we need to go big, et cetera. So what we look at is what are implied forward rates looking like and how close are they to the Fed's dot plot. And those are right on top of each other. We're talking about 3% at the end of 2025, a little bit below 3% end of 2026. But yeah, no, the Fed forced the market to come to its level. I know there was some adjustment in the dot plot, but there was a lot more adjustment in implied forward rates.